Okay, let's dive right into this. Welcome to today's explainer, where we are going to unpack a seriously fascinating piece of economic strategy: Nigeria's wealth tax. This is a topic that sits right at the intersection of public policy, national revenue, and everyday consumer habits. We're going to look at exactly how a nation shifts its financial gears, targeting a very specific demographic to balance the books. Now, to really get why this policy even exists, we've got to look at the economic landscape. 100. That is the number of billionaires living in Nigeria. Just think about that for a second. That alone paints a vivid picture of the immense concentration of wealth within the country. But wait, it doesn't stop there. What's really interesting is how this scope broadens. Beyond those 100 billionaires, Nigeria actually boasts more than 100,000 multimillionaires. And perhaps the most staggering statistic of all, the country has the absolute highest number of private jet owners anywhere in the world. No way, right? This extraordinary level of affluence, combined with a well-known penchant among the wealthy for purchasing super expensive items from abroad, completely sets the stage. This is exactly who this specific economic policy targets, and the stakes for generating revenue here are absolutely massive. So here is our roadmap for this explainer. First, defining the luxury tax, then a rocky road to implementation, what counts as luxury, the price of luxury, and finally, the economic benefits. All right, let's jump straight into Section 1, defining the luxury tax and its role as the proposed solution to declining revenues. You see, starting around 2013, Nigeria's revenue from the oil and gas sector just started dropping. It was a steady decline, and the government urgently needed to look for other sources of income. It was absolutely crucial to broaden the non-oil tax base. So what exactly was their proposed solution? A luxury tax. This is simply a tax slapped onto goods and services that the government considers to be non-essential. We're talking about items consumed almost exclusively by the wealthy class of society. By implication, this tax is laser-targeted at the super-rich, because they are the ones with a disposable income to actually purchase these highly expensive items. Structurally, these goods and services are assessed for tax as a percentage of the sales price, but critically, at a much higher percentage than your regular standard sales tax or VAT. And this brilliantly illustrates the dividing line the government drew. On the left side, we have basic food items. These are everyday, essential goods that are strictly 100% exempt from this tax. The government was super clear that the everyday citizen just buying necessities would not be impacted. But over on the right, we have high-end goods. These are the non-essential items specifically targeted for the super rich. It's a really clear distinction between everyday necessity and sheer extravagance. Moving right along to Section 2, a rocky road to implementation. Tracking the policy from 2013 to Tax Thursday. Let's walk through this timeline together to see exactly how this unfolded. The catalyst, as we mentioned, hit in 2013, when oil sector revenues began their steady decline. Fast forward a bit to August 2014, and the federal government, led by President Goodluck Jonathan at the time, officially announced plans to introduce this luxury tax. However, almost immediately post-2014, the actual implementation was completely suspended. Why? Well, because of the intense controversy it generated. So it just sat dormant until 2016. That's when the idea was reactivated by Finance Minister Mrs. Kemi Adeosun, though initially without stating the specific goods or rates. Finally, in August 2017, the government embraced modern communication. During a Facebook Live chat cleverly tagged Tax Thursday, Minister Adeosun finally laid out all the specifics and clarified exactly which items were in the crosshairs. Which brings us perfectly to Section 3, what counts as luxury, identifying those targeted goods and services. Here is exactly what the government officially classified as non-essential luxury consumption. For travel, they're looking at first-class airline tickets and luxury coaches. Over in the beverage category, it targets champagne, brandy, whiskey, and wine. And finally, jewelry, with a really specific emphasis on high-end pieces. Seeing it all listed out gives us a very tangible sense of what the government actually considers a luxury lifestyle in Nigeria. Let's move to Section 4 and see how this builds. The price of luxury, exploring the 2014 proposed tax rates. To really understand the impact here, we need to look back at the original policy thrust from the Goodluck Jonathan administration in 2014, which actually put hard numbers on these items. And the rates on these vary wildly. At the very top, luxury yachts were slapped with a massive 39% import surcharge. New private jets, reflecting that super high ownership demographic we talked about earlier, were hit with a 10% import surcharge. luxury cars faced a 5% surcharge, and champagnes, wines, and spirits had a 3% luxury surcharge attached. I mean, think about it. When you apply a 10% tax to a multi-million-dollar private jet or a 39% tax to a mega yacht, you're turning a policy idea into a major, major stream of revenue. And there was one more huge asset class targeted. 300 million. That number represents the 300 million naira threshold for residential mansions in the Federal Capital Territory, Abuja. If a residential property was valued at 300 million naira or above, the 2014 proposal suggested it would be subjected to a 1% mansion tax. So essentially, they were targeting luxury in the air, on the sea, in your glass, and right there on the ground. This leads us right into our final section, Section 5, the economic benefits, and why this tax actually matters for the country. Ultimately, what is the endgame of this entire policy framework? Well, this policy targets 4 main benefits. First, to raise some serious government revenue. Given the number of wealthy individuals purchasing these expensive items, the expected annual revenue is just massive. Second, to broaden the tax base. It strategically moves the country away from its heavy reliance on the declining oil sector. Third, and so the crucial point is, to redistribute wealth from the rich to the poor. The tax generated is intended to be used to provide social amenities for the broader populace, directly addressing social imbalances in the system. And fourth, to mitigate the consumption of extremely non-essential items. The big idea is that full implementation might actually curb the appetite for buying these extravaganzas in the long run. But that last point brings up a fascinating dilemma and a final question for us. Will taxing the super rich truly curb the consumption of luxury goods in the long run, especially given consumer habits and the elasticity of demand? Think about it. If someone can comfortably afford to buy a private jet, is a 10% tax really going to stop them from buying it? The habit of the consumer and how elastic their demand is for these premium products will ultimately determine how much is purchased, and consequently, how successful this tax will truly be. It is a wildly complex balancing act between generating revenue and trying to change behavior. Anyway, thank you so much for joining me for this explainer, and I will leave you to ponder that final thought.